All right, time to learn about taxes. So we talked in the last lecture about budgets and sort of money coming into the government and being spent. We mentioned briefly about income taxes, but I think in this lecture, we're going to talk very specific about how your personal income taxes work. Again, this is sort of a non-standard topic for introduction to political science class or American government class. But because I think this is how you interact with the government the most, it's important for you to know. And it's actually a real skill that you can take with you after the class. So, whether you think it belongs in this class or not, I think it's actually pretty useful. And when I talk to students about things like income taxes, a lot of them have no idea how it works. So I find this is a pretty useful topic. Okay. So we're going to talk mostly about federal personal taxes. So they're state taxes, state income taxes. They're usually, less complicated. And I say that with a qualifier, they're less complicated, sort of, because the way most state income taxes work is you do your federal taxes, you come up with some number, and you start with that number on your state taxes. So all the, hard work or complicating factors are done on the federal taxes, and then there's a little less, that looks less complicated on the state side. Let's just say there's some states that don't have income tax. I lived in Texas, had no income tax, that was nice. I think Florida has no income tax, which is why a lot of people retire there. It's also why a lot of professional athletes live in Florida, because they can avoid some income tax, state income tax. Although, fun fact, if a athlete plays a game in a state, they have to pay income taxes there. So I don't know how many different states have, say, baseball teams, but every professional baseball player has to pay income taxes in all those states where they play a game. So someone has to file, 20 different state tax forms for them. Let's see, for state taxes, the rates are generally lower and there's fewer brackets, which means you usually reach the top bracket faster. The top bracket in Oklahoma is 5%. It used to be a little higher. That came down in maybe 5 years ago. It came down. As I said, some states, they don't have income tax. We're mostly ignore things like property tax and sales tax. Those are either very straightforward, I guess, like sales tax, or property tax can be complicated too, but we're not going to really get into those. I should say though, people say things like, oh, if you rent and property tax goes up, then your landlord can just raise the rent. No, that's not necessarily true, because you can only rent at basically market rates. Anyways, neither here nor there, but we're mostly going to ignore those things. Corporate taxes are a thing too, and remember back to the budget lecture, corporate taxes make up a pretty small percent of the federal pie in terms of money coming in, but they're largely invisible to us, and I don't know much about them, so we're not really going to talk about corporate taxes. Okay, so the bulk of this lecture is just going to really walk through how a person would do and calculate their income taxes. So basically, how much do they owe? I say at the end of the year, but we can file in April, but the actually tax year runs, they count your income over a calendar year. So January through December, which is different from the fiscal year. Okay, so these are tax brackets. I think I have them right for 2020. The brackets usually change a little bit each year based off of inflation and those sorts of things. So if you see another set of brackets and they're a little bit different, that's because they're probably just from a different year. And these brackets here are for someone who's single. So and we'll show in a little bit that your brackets, if you're married, are different than if you're single. So just a couple points from here. This percentage, so in this top box here, we see 10% of taxable income. So 10% is the rate for that bracket. So people sometimes talk about like, oh, I'm in the 10% bracket or I'm in the 22% bracket. I would say the number is meaningless, and I'll show you in a bit why it means less than we think it is. But if you're in a particular bracket, that's not the overall rate that you pay. So your bracket's different from your, what we would call an effective rate. Anyways, the lowest bracket's 10%, 12, 22, and so on and so forth. And so hopefully you watched the other video that's up on the page that explains brackets a little bit more. But basically, your first, this is the income range, your first bit of income is taxed at 10%. And then sort of your next chunk of income is taxed at 12%, and so on and so forth. And I should be careful, and we'll explain this again moving forward. Actually, generally, your first bit of income is not taxed in terms of the income tax. Said this a few times, everything's taxed for the payroll tax. Well, everything on the first end is taxed at the payroll tax. But we'll get into this more, but I just want to explain sort of what these brackets look like. And then these numbers here are what your taxes, how much you owe. So if you made $518,400, you would owe $156,235 in income tax. Sort of, if your taxable income was that much. Okay, so we're going to walk through an example. So I made up a person, Joe. Joe is single for now, going to get married later on. And Joe makes $50,000. Seems like I don't know, good amount of money, and the math, I don't know, guess it works out. Okay, so how do we calculate how much tax Joe owes? So we take the first $9,875, because that's the first bracket, 10% bracket there. And we multiply that by 10%, or 0.10, we get $987.50. We take the next chunk of money that's in the next bracket, 12%, so 4,125 minus the 9,875 that's already been taxed. We already calculated the tax on it. So do that math, then multiply that result by 12%, or 0.12, and we get $3,630. And finally, we take the money that's left, that's in the next bracket. So we take total income, $50,000 minus 4,125, multiply that by 0.22 or 22%, and we get 2,172.50. And so the total tax that Joe owes in this example, and we'll show how this isn't quite right later on, but we want to get a baseline, is $6,790. So Joe would say that Joe's in the 22% bracket, because that's the top bracket that Joe pays. But if we want to figure out like how much does he pay, what percent of Joe's income is taxes, it's 14%. So you would take the total amount of tax that we calculated, $6,790, and divide by $50,000 to get 14%. So the effective rate for Joe is 14%. It's not 22. And so I think that's the first thing people really confuse about taxes, is the difference between brackets and effective rate. Your effective rate is tax you pay divided by your total income. And these things almost always differ. I suppose if you were just in the 10% bracket, actually that's not even right. So they almost always differ. Okay, so some terms. And we talked about this a bunch already. Sometimes this is called FICA. Sometimes it's called payroll tax. This is the 7.65%. So 6.2% is for Social Security, and Medicare is another 1.45%. And remember, your employer pays this amount to the government too. So you pay 7.65% of your income, and your employer does too. So this is sort of separate, and this is calculated automatically. Your income tax is usually what you calculate at the end of the year. I've said this a bunch of times. If you're self-employed, your employer is also you, so you pay 15.3% into Social Security and Medicare. Okay, so there's payroll tax, and then there's deductions. Deductions are, it's money subtracted from your income before you pay taxes. Sometimes these are called loopholes. Generally, it's a loophole if someone else takes advantage of it. It's a fine part of the tax code if I take advantage of it. So what most people do is they subtract what's called the standard deduction, and I'll talk about that a little bit more in the next slide. But basically, you have the amount you owe, and then everyone gets to subtract a little bit. So for single people, your first $12,400 is not taxed. If you're married, the married couple's income is the first $24,800 is not taxed. For married people, it doesn't matter if one person works and earns all the money and the other doesn't, or they both work. The standard deduction is the same, and you generally file taxes jointly rather than separately. Sometimes there might be reasons to do it jointly or separately. I don't know why, but that is a possibility. But it usually works out better for you to file jointly. Okay, there's other deductions. Student loan interest paid. So when you graduate, you have student loans. I had student loans. The interest you pay is tax deductible. So that means is, and we'll walk through an example of that. If you paid $1,000 in a year in student loan interest, you subtract that from your income before you calculate your taxes. There's this, I think, kind of stupid part of the student loan interest. If you earn over $85,000, you're not allowed to deduct your student loan interest anymore. So say you go to college, right? Like they tell you to do, and the tax code has an incentive to go to college because you get to deduct your interest. You go to college, you get a really good job, but you're like, oh, I got to pay back my loans. But you're like, oh, I made too much money. Now I can't deduct my student loan interest. So you basically did exactly what you were supposed to do, but then you're kind of penalized for it. It's a real pet peeve of mine. I don't know. I'm done paying off my loans, but I always thought that was kind of silly. Some tuition and fees are tax deduction. Now, tuition fees depends a little bit if your parents claim you as a dependent or if you file your own taxes. If your parents do, I think they can deduct the tuition and fees, but you wouldn't file your own taxes anyways if your parents claim you. Some retirement contributions, health insurance premiums. So when we're on one of the earlier lectures, we went through a paycheck where I showed the before tax deductions, and some money I put into retirement accounts, some money that's paid for healthcare comes out of my, it lowers my taxable income. And because health insurance is a lot, sometimes it could lower your income by a lot. There's other things, flexible savings accounts. So the government lets you pay for some healthcare and some daycare with tax-free dollars. So I have a daughter in daycare. So we deduct money from the paycheck. It goes directly into this savings account that I can only spend on certain things, but it lowers how much of my income is taxed. And these are capped too. I think it's for daycare, you can do maybe $5,000. And I'm not sure what that cap is on healthcare. But again, you only spend these on specific things. You can't use your healthcare money and go out and buy a TV with it. Well, you shouldn't, because you could get caught. So with these deductions, we subtract the deductions from your total income, and we start to calculate what's called your adjustable gross income. And I'll walk through examples. But basically, you have total amount of money you make in a year. Say you make $50,000. Then before you pay your income tax, you would subtract a standard deduction, and you might subtract some student loan interest you paid. And so it makes it look like, I'm gonna walk through examples, that like you owe less in taxes than your total amount of income. That's, I don't know, generally a good thing. Everyone should pay their taxes, but very few people want to pay more. Okay, so we're back to Joe, and we'll walk through an example with standard deduction. Oh, sorry. Let's see how I really explain this. So if you make less than $12,400 a year and you're single, you pay no income tax. If you're married and combined, you make $24,800 or less, you pay no income tax. Just real quick, so 44% of the population pays no income tax. And out of that 44%, 2/3 of them still pay the payroll tax because they work. So if someone says, oh, 44% of the population, they don't pay any taxes, that's not true. They don't pay income tax, and that's because they don't make enough money. They still pay their payroll tax, they pay property tax, sales tax, gas tax, all these other taxes we talked about. They just don't pay income tax. There are some people that maybe pay very limited tax. If you're old and don't work, you don't pay the payroll tax, and they're really poor. If you don't work, you don't pay the payroll tax either. Okay, so sorry, back to the working example to explain the standard deduction. So remember, Joe makes $50,000, and his standard deduction is for single people is $12,400. So we take his $50,000, subtract the $12,400, and his new adjusted gross income is $37,600. So this is where we calculate the tax from. So instead of the $50,000 like we did before, we start calculating the tax from this lower amount. So the first bracket's the same. So $9,875 times 10%, we get our $9,850. And that is where it starts to change. We now take the AGI 37.6 minus 9,875. The math is the same, the numbers just differ, times 12%. So the next bracket there, we get $3,327. We don't do the 50,000 calculation that we did before. And so the total tax is $9,850 plus $3,327 to be $4,314.50. So his effective rate is now 8.6%. So his effective rate goes down. And over the course of these examples, the effective rate is going to go down because we're taking either deductions or credits or other things. So before, I think it was 14%, right? Now it's 8.6%. So just by having the standard deduction, which we all get to take if you file your own taxes, your effective rate goes down, the amount of tax you pay goes down. So this is why if someone said, oh, you know, I make $50,000, I'm in the 22% bracket, it's not right because they're only paying 8.6% income tax. Okay, now we're going to do standard deduction plus some student loan interest. $50,000 income, we subtract our standard deduction, we subtract our student loan interest, and now our adjusted gross income is $35,600. Same calculation of the first part and then the next part. So even less income in that 12% bracket. Don't do the top anymore. So your total tax now is $4,074.50. So this drives your total tax, your effective rate down, total tax and your effective rate down even more. Okay, so now let's pretend Joe got married, right? We said the standard deduction doubles for married couples. And incidentally, this was kind of tax and kind of some other parts were part of some of the marriage equality cases. I think actually it might have been an inheritance issue that actually there might have been a tax component of the inheritance issue where same-sex couples were not allowed to legally be married, and so they weren't able to take advantage of these parts of the tax code. Okay, so these are the brackets for married couples. So the percentages remain the same. And what happens is it's just the amount of money you can earn in the different brackets changes. It basically doubles. So in each of these brackets, instead of if you're single, your first $9,875 of adjusted gross income is taxed at 10%. Now it's twice as much. So basically everything doubles in these categories. The rates stay the same. So you basically pay less in taxes by being married if you had this same amount of income. Makes her married Joe makes 50 grand, standard deduction, student loan interest. AGI is down now to $23,200. It's less than half of the $50,000 that Joe makes. So now we calculate again. The first $19,750 is taxed at 10% instead of $9,875. Then the next part is taxed 12%. Do the math. And so our total tax now is $2,389. Effective rate is down to 5%, right? So by sort of taking advantage of different parts of the tax code, now you shouldn't get married to take advantage of the tax code, but the tax code incentivizes marriage over cohabitation because you can take advantage of some parts of the tax code. There are other laws that actually don't take advantage. There's some things that you wouldn't qualify for if your income comes up. There's all sorts of things in our laws that make that either incentivize marriage. Sometimes they incentivize divorce. trying to qualify for a Medicaid nursing home as a senior, you basically can have no income. It's kind of a sidebar here, but there are cases, and it's a little hard to do this now, but an elderly couple where one spouse has to go into a nursing home would actually get divorced to make it look like, and then one spouse takes all the money and the other spouse has none. It makes it look like one spouse has no money, so they qualify for the free Medicaid nursing home. Neither here nor there, but anyways, the tax code and these other laws incentivize certain behaviors. Okay, so there's the standard deduction, which we talked about, but there's also itemized deductions. And so these are types of spending the government says that can also lower your adjusted gross income, so more loopholes. Charitable contributions. So charities will frequently say like, oh, give us a contribution, it's tax deductible. That is true, but you can only deduct it if you itemize your deductions. If you take the standard deduction, you don't get to itemize as well. And then the way the tax laws are set up now, most people take the standard deduction. A large percentage of people file their taxes do standard deduction. You could deduct from your taxes, again, if you itemize mortgage interest. So the government is incentivizing purchasing of homes, and actually on the back end, this sort of, I think, in some ways can inflate home prices. So there are consequences to this. You can deduct your state and local taxes. So your state income tax, your property tax, sometimes sales tax, but this is capped at $10,000. This is sometimes called the SALT tax, state and local tax. This cap is recent. It's part of the 2017 changes in the tax code. You can see this is taxed at $10,000, or capped at $10,000. Most people take the standard deduction because it's bigger. Doing taxes is hard sometimes. You can pay someone else to do your taxes. As it turns out, the money you pay someone else to do your taxes, you can subtract from your income. If you itemize. So you either take standard deduction or you itemize. Take whatever's bigger. Most people take standard deduction. How do you know which one's bigger? You got to do your taxes both ways to figure it out. But for most people, the standard deduction works. I used to itemize, and then under the new tax code, the standard deduction was better for me. Okay, so we talked about deductions. Deductions are subtracted from your income. Now, credits are subtracted from the tax you owe. So generally, credits can be better than deductions. And we'll walk through some examples, but you can only take so much in credits. Credits are rarely refundable. Refundable means if you owe zero in taxes and you have a credit, you would get money back from the government. There's some credits that are refundable, most are not. So you can't pile them up on top of each other. Although you can sometimes decide what year you take them. So usually credits are a percentage of something, of a cost of something, or they're capped at a certain amount. And sometimes you only qualify for the credits if you make under a certain amount of money. So some examples, childcare. So you can get up to a $3,000 per child credit for childcare. And this is different from the dependent savings account we talked about at the beginning. And generally speaking, if you are lower income, you would take this tax credit. Higher income, the dependent care is better for you, and depends on how many kids you have too. So $3,000 for the first child, $6,000, so doubles for the second child and any other child. So max is $6,000. So post-secondary schooling, sometimes there's credits. This is a fun one. I took advantage of this. Investing in solar products for your house. So the tax code incentivizes actually having children. Incentivizes doing sort of things that are better for the environment. So energy efficient products. So this is weird. So I spent, I don't know, let's say it's $5,000 installing skylights in my house. The solar panels have a motor that opens and closes the skylights. It's powered by this like tiny little solar powered battery, but it qualifies for a 30% tax credit. So let's say I spent $5,000 to get the skylights installed, times 30% is $1,500 off my taxes. So basically what this means is, I paid the installer $5,000 to put in the skylights, but once I got my tax credit back, that means it only cost me, I have to do math on the fly, it's $3,500. And of course, the installers rig the bid, so they make it better off for you to install this one. Because you can get skylights that don't have the solar part. They're a little bit less, but at the end of the day, if you get your tax credit, it's actually it's cheaper to get the ones that open with the solar motor in it. It's really not saving, it's not making anything like more energy efficient. In fact, I'm less energy efficient because I put a big hole in my roof. So I don't know, I took advantage of it. I wanted the skylights, it's nice, get some natural light. Electric cars. So for most electric cars, it's fully electric, there is a tax credit. So the tax credit disappears once the 200,000th car has been sold, right? So this incentivizes either me to purchase an electric car, and I did, or companies to make them because it makes it cheaper, right? So a Tesla might cost $40,000, but at least at the beginning, before the credits were all gone, you would get a $7,500 tax credit back. So that lowers the price of the car effectively. So yeah, the Tesla credits are all gone, but the other electric cars don't sell as much, so you might get it. And actually it ratchets it down. So I don't know, at some point you get, $3,250, you get like half the credit and so on and so forth. Anyways, we'll walk through an example. So here we got Joe buys an electric vehicle. So $50,000 in income, standard deduction, student loan interest, and we did the calculation. This is the exact same way it was before. Tax owed, so it owes $4,074.50, but he buys an electric car, not a Tesla because the car's gone, but buys some other, Porsche makes one, it's like $100,000. Oh, it's an awesome car. So he buys his Porsche, I don't know how he affords it on his $50,000 salary, but he does. And so he gets this $7,500 tax credit. Subtracts that from his tax, and he owes nothing. So it's not refundable, so he can't get extra money back. But he owes no taxes. Why? Because he bought this fancy electric sports car. Pretty good deal. So his effective rate is 0. So, the tax code incentivizes certain behavior, and it can lower the amount of taxes that you owe. So we walked through an example, and this is actually what it would look like if you wanted to do your taxes on paper. So this is 1040. This is the most basic tax form. It gets more complicated. And those examples, if they look complicated, those are actually like pretty simple ones. Taxes can get way more complicated. But we'll just do the simple stuff. So this was a tax form. So first you sort of check off, are you single? Are you married? There's these other ones too, but for the most people, it's single or married filed jointly. You got to put in your social security number. These are always fun. So you can check this box that say if you want $3 to go to the presidential election campaign fund, and then this money gets distributed evenly between the candidates who qualify. It doesn't affect how much tax you owed, but I don't know why it's on the form, but there it is. Okay, if you have dependents, so you actually save money on your taxes for each child, and I maybe should have walked through an example where Joe and spouse have a child, adopted, have a child, doesn't matter. But anyway, so you deduct a certain amount of money for each child, a credit. You have to enter the social security number. So this is really just to say, so before 1987, you didn't have to put a children's social security number on the tax form. So in 1986 was the last year you didn't have to put your kid's social security number down. So they compared how many children were listed on tax forms in 1987 and 1986. So in 1987, when the law went into effect, there were 7 million fewer children counted on the tax forms. So what does that mean? Basically, people were lying, right? They were listing like, oh, I had a kid, and you get this tax savings. So 7 million children were listed. They kind of dug into this. It's actually funny. What? I don't know. 11,000 families in their tax form claimed 7 children in 1986, but not in 1987. I mean, it's total fraud, right? You should go to jail for lying on your taxes, or I don't know, pay a fine or whatever. But there was 11,000 families put 7 children, right? Like, I can imagine like ramping it up to like the first year, like 1 kid, okay, yeah, and then 2, and then you're like, twins, you're up to like 4, and eventually you get to 11 kids or 7 kids. So they listed 7 in '86, but they're like, oh, I probably shouldn't cheat. I don't know if they went back and like caught people. I think these people listed 7 kids. They went back and like, okay, you owe us some back taxes. Okay, so this line here, you list your income. So we would list the $50,000 before, right? If it's Joe doing this single, actually, or married. I didn't talk about these things, but you pay taxes on other stuff. So let's say I earn interest on a savings account. I would put the amount of money in there, and then it counts as income too. Sometimes if you sold stocks or something, you would put that in here. So there's other income besides wage income that counts. This line here, you say, are you going to take the standard deduction or are you going to itemize? And so the standard deduction, 12.2. These numbers are a little bit lower because this is the tax form from last year. The examples I worked through from 2020, and this is from 2019. So it's just a little different. And then you add everything up, and that's your taxable income, right? Sort of your adjusted gross income, right? Because you would subtract the standard deduction or itemized deduction. And there's other things you might subtract in there. Okay, this is the second page. It's funny, when they passed the 2017 tax cuts, like, oh, you should be able to view taxes on a postcard. Like, it's a little bigger than a postcard, but anyways. You calculate how much tax you owed, and it's like, you can do it on a postcard, see instructions, right? So like, go to this other, it's like choose your own adventure. Go somewhere else and see how much tax you owe. There's other sort of parts in here. You would list how much tax was withheld on your paycheck over the year, and that there's a tax form you get from your employer that tells you. And so you get a refund. If your employer withholds too much money, you get a refund, right? So if they withhold more money than taxes owed, you get a refund. If they didn't withhold enough money, then you obviously have to pay taxes at the end of the year. So when people say things like, oh, I got a $1,000 refund, like, yeah, you got $1,000, but like your tax situation might not be any different than someone else who makes the same amount of money. The refund is just how much was withheld over the course of the year. So I think people are like, oh, I like got a refund this year, but had to owe this year. Like, there could be lots of things going on, right? The amount of refund you get can be independent from like how your taxes work. I guess people put too much into the refund, and you could owe money too. Okay, so we walked through all that. You're like, wow, you got to calculate this. This is hard. There's instructions. So fun fact, the government, for most people, knows exactly how much money you made, right? How do they know? Because your employer tells them. And you get this tax form that says, here's how much you made, and the federal government gets a copy, right? How do they know if you cheated on your taxes? It's because they already know how much money you make. So for most of us, the government could do our taxes for us, send us the form already filled out, and you'd just basically say, okay, I agree with this. If not, and you would have to like show why it's wrong, I guess, right? However, so why don't we do this, right? Some other countries do this. Tax software companies, TurboTax, which is actually owned by Intuit, they lobby against this because they have a whole business. It's like $1 billion industry related to doing taxes for people. So I use TurboTax. My tax situation is a little complicated because I have some other things going on, but you know, I probably pay TurboTax a couple $100s a year to calculate my taxes. Okay, so yeah, the government can do our taxes for us. TurboTax lobbies against it. In exchange for TurboTax and other companies, there's H&R Block's the other big one. So the government's like, okay, fine, you can keep your businesses, but for people who make under a certain amount of money, you have to have a free option where they can calculate their taxes using your software, but you won't charge them anything. TurboTax is like, yeah, we'll do that. Turns out they would totally trick people. They'd be like, click here to use the free version, but it wasn't free. And so it was almost impossible to figure out how to actually use the free version. And the government's not happy about that. But what are you gonna do? Okay, So I mentioned a couple times this 2017 tax reform. So Trump and the Republicans passed tax reform in 2017. What did it do? The big picture, increased the size of the standard deduction, but actually eliminated some other parts of the tax code. It did simplify things. I think the newer taxes are probably a little simple, but personally, simple for me doesn't matter. I just use the TurboTax. I'd rather just pay less in taxes, which that also happened with this tax code. But anyways, they always like sell like simplify as like this great thing, but I don't know, it doesn't work for me. So they capped this SALT tax, the state and local taxes, at $10,000. And so for lots of people, this didn't matter. But if you live in a state, especially like New Jersey, New York, California, Connecticut, has really high state taxes and property taxes, you really lost out under this new code. Think about those states I named: New York, New Jersey, Connecticut, California. Are those states that vote for the Democrats or for the Republicans? Vote for Democrats. So, I think this part of the code has changed. It's basically like, like this is going to make Democrats worse off. Who cares? And sort of works out better for the way the taxes worked, at least overall. So we can lower things, but some people are worse off. Change the tax brackets, and I'll show you in the next slide. You get more tax savings for having children. Most people pay less in taxes. The people who pay more are these people who probably live in the high tax states, like the ones I named. And some pay a lot less. Like if you're really wealthy, you probably pay a lot less, and I'll show you why. And what this means is there's less money coming to the federal government to fund the programs like we talked about in the last lecture on the budget. Okay, so this compares the old brackets and the new brackets. And these might have been like the 2017, 2018 brackets. So again, you'll notice like this number 9,525 is a little different than the $9,800 number I showed before. And that's because these things change every year, but we wanted to compare the old brackets with the immediate new ones. So anyways, so these are the rates, so old and new. And so things differ at different times. So the first part, this 10% bracket stays the same for everyone. So there was no change in the 10% bracket. So everyone paid the same amount of tax on their first 9,500 whatever dollars of their taxable income. Moving up though, on the next one, the next tax rate, so same size brackets, goes from 15 to 12%. So if you're in this next place, you start to save money on your taxes. Move up to the next one. Now actually the money in here changes too. The high end in the old one was 93,000. The high end in the next one was 82,000. But the rate goes down by 3%. And you can work through the rest of these and you can see how the rates are lower. You get to the top bracket. So if you make over $500,000, now you pay 37%. Before you're paying 39.6%. You're like, oh, it's not that much. 2.6% of $500,000 gets to be a big number. Imagine you made $1 million and you're paying 2.6% less in taxes. That number starts to add up. So this is why the wealthy sort of benefit the most from the tax cut. So their savings from before to after is higher. Now, it's perfectly legit to say the wealthy are also paying a lot in taxes, but they're paying less now than they were before. Okay, so just sort of summarize, the tax code encourages certain behavior, buy energy efficient things, sort of encourages marriage for the most part, encourages having kids, although like children are not net savings. Daycare is expensive. It mostly encourages work, right? So you only get some things if you work. Taxes, like the budget, like everything in our government, this is probably a theme, blank lecture, things can be extremely complicated, but they are, but actually they don't have to be. So you could really simplify the tax code if that's what you wanted and just have a flat tax. So the flat tax would say everyone pays, I don't know, 12% tax on all their income, or some version of that. Some have like this, well, first $10,000 is free and then 12% after that. No deductions, no credits, none of that. So you could have a much more simple tax code if you wanted to. I don't think that necessarily works, but that's a possibility. I think the flat tax, the rate would have to be much higher than people want it to be. So if we switch to a flat tax, lots of low-income people would be worse off, and the wealthy would be made better off. So generally, people who argue for the flat tax are wealthy. So if you want to try some examples of working through your own sort of how to do your own taxes, these two sheets here give you some examples on how to do that. So I might recommend taking some of the examples we worked through and see if you can get numbers that are similar. They might not be exact, and again, it's because like the brackets change a little bit from year to year, and some of these things update, and I really can't control it. But it's worth sort of thinking about if you want. So that's taxes. Hope you learned something. If you take anything from this class, I hope you know, like, oh, I know how to do my own taxes. That is a useful skill. And actually other people will pay you for that. So, all right, that's it.